clocks have sprung forward, the FTSE 100 continues to blossom as it reaches towards fresh all-time highs, and we have a busy week ahead, especially on the corporate front. On Tuesday the 28th, we have numbers or trading statements from United Utilities, travel agent Thomas Cook, and newly merged bookmaker Ladbrokes Coral. On Wednesday the 29th, Stagecoach and AIM quoted flooring specialist James Halstead will be the names in the frame. Halstead is particularly well known for its remarkable streak of annual dividend increases. And on Thursday the 30th, all eyes will be on Tesco's merger target and wholesaler Booker. But for me, the biggest potential source of a fuss in the week ahead will be interim results from plumbing and heating equipment distributor Wolseley due on Tuesday the 28th. Now the shares have suffered the odd lump and bump over the last 12 months amid concerns over trading in the UK and also the Nordic region, but overall they've done well, as we can see here, with a 30% gain outpacing the FTSE 100, which for the record is up 20% over the comparable 12-month period. Three factors look to underpin that share price gain, and you need to think about all of them when you study the first half figures. First, Wolseley generates 2/3 of its sales and more than 80% of its corporate profits in America. As such, it's a beneficiary of the strong dollar, or at least a weak pound, and would like to see President Trump's planned reform programs give the US economy a shot in the arm. Profits rose 13% in the States last year, and as you can see here, Wolseley's share price and the dollar-sterling exchange rate seem to be hugging each other, at least for now. Second, the UK business may have been suffering from price pressure and stiff competition, but Wolseley has outlined a restructuring plan for the operation, closing 80 branches and cutting 800 jobs at an initial cost of £100 million. Profits fell 18% in the UK last year to less than 10% of the total. Finally, a 12% profit drop last year prompted a strategic review of the Nordic operations. Some analysts are actually arguing this will eventually lead Wolseley to withdraw from the UK and Scandinavia altogether and just focus on America. To judge how each unit is doing, you can also check out the like-for-like sales growth by region. This chart shows the trends over the last 9 quarters, with the US first, then the UK, and finally the Nordics. As you can see, the US accelerated in the last quarter, but the UK and Nordics got worse, although the result was an improvement in like-for-like sales growth from 1.5% in Q4 to 1.8% in Q1 overall at group level. So let's see how the second quarter looks. In terms of actual headline numbers for the full year, the analyst consensus is looking for more than a 1/3 jump in pre-tax income to just over £1 billion, a 20% rise in earnings per share, and a 15% increase in the dividend to around 114p. Last year's interim was 33.3. That 114p estimated dividend would be enough for a yield of 2.3%, and the forecast payment is covered a healthy 2.6 times by earnings. All of those percentage changes for the full year should be decent yardsticks for the first half. The final question to address is then that of valuation. A 2.3% yield is a discount to the wider market, even if earnings cover for the payment is way above average, and a forward price earnings ratio of 17 times is a small premium. As such, a lot of hope regarding the US economy and some degree of the potential of the restructuring programs already looks to be factored into the rating, given particularly a 2-year slowdown in sales growth overall. So anyone researching the stock will need to bear this in mind, as well as whether Wolseley fits with their overall investment strategy, target returns, time horizon, and appetite for risk. Thank you for watching, and I look forward to seeing you next time.